I think a lot of folks are trying to figure out if there's something that they should be doing with their portfolio ahead of, during, or after this meeting, but probably for our purposes, ahead of right now.
Yeah, so it's a complicated question, and it's hard to have conviction in these markets. But I think one of the things that we saw yesterday, which is a very important signal, is the fact that the 10-year crossed that 3% threshold, which means that we really touched real positive real rates for the first time in a long time. And so one of the things that we've been doing within our portfolios is raising quality, not only in the equity side, but now we're starting to see some value in asset allocation and bringing bonds back into the equation, both in terms of the yields that we're seeing and the chance that we may indeed hit peak rates, whether it's now or whether it's sometime this year. We have high conviction that it will happen. And so with that, we think that there's value in creating that diversification, and that asset allocation is back.
So bonds are back, baby. Where?
So again, I'm going to talk about quality here because it's not all bonds are back. So the investment thesis at this stage, given the uncertainty, given the volatility, we basically have a pretty equal strategy when we're looking at what we're doing within our equity portfolios as well as our fixed income. So let's start with fixed income, where we see value in treasuries, we see value in investment grade, and we actually see value in munis for taxable investors. When you look at those yield ratios of where munis are yielding relative to taxable equivalent bonds, it's about at 90%. And so we're very comfortable adding that exposure to diversify our portfolios.
What do you do on the equity front? I think there's a lot of folks that are still holding on to some stocks, including FANG stocks and NASDAQ stocks that have come down a lot. I think there's a question as to are these falling knives that are continue to fall, or is just everything on sale?
So let's talk about where we've added exposure, and then I'll touch upon the question on technology. So where we've been adding exposure, and this has really been a story since Q3 or Q4 of last year, dividend growers. So these companies with strong management, strong balance sheet, durable demand, and this ability to grow earnings, even with some of the pressures that we're seeing. Interestingly enough, with the S&P 500 down around 14%, the NASDAQ over 22%, these companies have actually held up pretty well, all things considered, down around 7% when we look at that specific area of dividend growers. On the tech question, one of the things that I will say is I think for a really meaningful turnaround in tech, we will need to see some strong messaging from the Fed and potentially even a U-turn. But again, look for quality there, because when you're looking at what's happening under the surface, the NASDAQ's down 22%, but you have about, let's say, 30% of those underlying stocks in the NASDAQ composite are down 60% or more. So there definitely is some carnage there. But again, we're advising our investors to focus on quality and focus on the profitable companies, not the ones that are a call option on an unknown future at this point in time.
Shepard Smith here. Thanks for watching CNBC on YouTube.